Good evening and welcome to the Jon Sanchez Show here on News Talk 780 KOH. This is Jason Gaunt. I will be sitting in for John today and tomorrow. He is away, getting a little bit of vacation. It's a business-related vacation, but since he's not sitting in front of the screens, I'm going to call it a vacation because, why not? It's fun to be jealous. Interesting day today. Certainly no shortage of news, be it Venezuela, be it comments about Trump and Blackstone, many things, Greenland, throw them all out there. Our friend Donald Trump went quiet for a little bit, maybe a week or so, but I would say has come out swinging here in 2026. And the markets, ironically, have been somewhat muted around many of the comments. There's been certain areas of the market that have picked up into the end of 2025 and have come out blaring so far this year. Small caps, for example, are up, coming into today, north of 4% just in a couple of trading days. The Dow has outperformed the S&P, as I often joke with John about the Dow being 30 stocks, et cetera. But, industrials have been outperforming, though they did lag a bit today, and we'll touch on why. It's a fun market, right? There's a lot of places that you can be invested. There's a lot of places that can be fun to toil with, and others that can make you cry pretty darn fast just because of the speed and the velocity of news that we're dealing with every day. And today was no different. Today, the Dow finished down 466 points, or 0.94%, to 48,996. The S&P was lower by 24 points, 0.34%, to 69.20, and the NASDAQ was in the green, up 16 basis points, 0.16%. That's 37 points higher. Gold finally gave back a little bit today. It was down 0.65%. It was down 1.5% earlier in the day to 44.67. Oil, much talked about, down 1.28% to 54.60. Part of the reason of that, Trump announced today that Venezuela will immediately begin providing the U.S. with 30 to 50 million barrels of oil, which I heard this morning was about a month and a half worth just of normal production. Helped a lot of the refiner names locally, Valero being one of them, up about 3%. That oil, again, until we find out differently later, the profits from it, or the revenue from it, profits to be determined later, the revenue from it is to be kept in U.S. banks and eventually redeployed back into Venezuela. Not on video tonight. One of my eyes is rolling. We will see. But that is at least what is being told, that the profits, the money that comes in from these oil sales will not be used domestically, even though the supply will be appreciated, especially at such lower levels of oil prices. But for now, anything coming out of Venezuela, many of the sanctions were lifted, certainly between the U.S. and Venezuela. However, there were comments made around China and some of the Russia, Iran even, that they weren't to get such a pleasurable deal as the U.S. is getting. And in fact, sort of by all accounts, it's a bit of a stick to China because they were getting a fair amount of oil from Maduro's regime. Other areas that Trump was very involved in today, unfortunately, this is one of those markets, again, where it's being moved around by what used to be called tweets and are now whatever Truth Social posts are called. But the industrial sector was down almost 2% today. That's part of the reason why the Dow acted as poorly as it did relative to the other indices I mentioned. He mentioned that he would like to see 50% increase in defense budget. This came out later in the day, but early on, he said, I will not permit dividends or stock buybacks for defense companies until such times as these problems are rectified, citing executive pay and slow production of military equipment as the problem. So that aerospace defense sector was down about 1.7%. He singled out Raytheon, stating that they were, again, not to steal his words, but they were certainly not the most helpful of the others. Whereas post the close, Lockheed is up about 6%. Northrop Grumman now is up about 4%. LHX up 4.3%. So a little bit of rally in some of the defense names post the close, but there was some volatility for sure, just given the fact that he stated that there would not be any buybacks. And the tough part is, here's what the market's saying. I'll leave my opinion aside. The market is saying, Tom Lee was on today. I thought something interesting about that. Unfortunately, now you're getting a case of the government picking who the winners and the losers are, right? And that is where things start to get concerning, where it's not a market anymore. It's more of what works in other countries of sort of greasing the palm or greasing the ego in order to get either what you want accomplished as a company, or some of your, those who push back are seeing the stick side. They're not getting the carrot, and they're been commented and such that it just creates a much more convoluted and confusing investing environment, right? So instead of picking good companies, you also need to add in characters at said companies that are more or less apt to say something destructive for shareholders, right? Whether they are lean one side or lean the other or just frustrated, it could certainly cause some angst and volatility in share price. Healthcare, very strong today, up about 1%. I mentioned months ago, biotech, right? This is an area I think that's got a bit of a double-edged positive to it. I think it's an area that will very much benefit from AI. And a little bit later in the show, I have an article from MIT Sloan's management review that digs into some of the AI concerns and the comments of what they think are the major trends over the next year to pay attention to. But I think healthcare, biotech is very much in a good spot for AI and the efficiencies from data consumption, data testing, data procurement. And we saw 2 merger rumors today, one of which Lilly, who was up about 4%, is in talks to acquire Ventyx Biosystems, and VTYX, that stock was up 36%. And AbbVie was rumored to be buying Revolution Medicines. AbbVie was up 4%, and Revolution was up 28.6%. Right, so chasing M&A oftentimes can be a good area to at least be doing some work on. Healthcare, biotech, those are all areas that, you get the tailwind of potential AI, and you also have a lot of patent cliffs. A lot of these bigger companies, the Lillys, the Pfizers, et cetera, the things that they've had before have run their course. GLP-1s, all the hype around that is starting to wane. They need to start going after other big biotech companies for other rare diseases and such to try to grow their pipeline. So it's a place to certainly keep a close eye on. I believe biotech was up, the ETF that I track was up north of 3% today. Very diversified. You've got large cap biotech, small cap biotech. So as you're looking to allocate, it's not a bad place to have a little bit of toe in the water, given some of these potential positive tailwinds. And then finally, lower interest rates. Biotechs borrow in order to fund their business. So as interest rates are lower, and of the opinion that they continue to go lower, they're favorably positioned that their borrowing costs could be lower. So I know I'm supposed to tell both sides of the story. Biotechs are volatile. Their drugs don't necessarily always work. So there's it's a bit of caveat emptor in there. But if you're looking at spaces, I think biotech's a pretty smart spot to start thinking about. Along the side of treasuries, right? Interest rates. Today, the 2-year note was down 1 basis point to 3.47. 10-year bonds closed at 4.14. So despite the recent comments around Greenland, and we'll get into some of the comments later, Venezuela, China, you name it, U.S. Treasury interest rates have stayed fairly calm, and that's what you want to be watching. If the rates complex is chopping around and people start to worry about debt and borrowing costs, that can cause the market to really pressure itself lower. But right now, interest rates have stayed fairly calm, and that's a good thing, despite the fact that you're seeing a bit of chop with certain areas of the market. But unfortunately, it's a news market now. It is, at least near term, it is a Trump Truth Social market. And that tends to cause a little bit of angst for folks who are used to quiet times of picking stocks and expecting earnings growth, which many of the analysts think could still be double-digit positive this year, which is a good thing. But it's time to maybe think about taking a chip or two off the table if you're fully invested. If this volatility is causing you to be a little more worried than you normally would, because I think this is going to continue for several more months into 2026. But why don't we check in now with Kristen Snow in the Right Now Traffic Center. How you doing, Kristen? Welcome back to the Jon Sanchez Show here on News Talk 780 KOH. This is Jason Gaunt. Today, the Dow finished lower by 466 points, or 0.94%, predominantly due to the industrial weakness. 48,996 again was your close. S&P 500 was down 24 points, 0.34% to 6920. And the NASDAQ was higher, up 37 points, 0.16% to 23,584. Gold here in the news session got going back the direction it's used to, up $5.70 to $44.68. Oil up 36 cents or 0.64% to $56.35. Though early in the year, going through the leaderboard here, the Russell 2000 is higher by 3.8%. Dow Jones is up 1.9%. NASDAQ Composite higher by 1.5%, and the S&P up 1.1%. On the data side today, we did get weekly MBA mortgage applications. They came in a bit lower than expectations, down 9.7%. Consensus was looking for a drop of 5%. December ADP employment came in 41,000 jobs, just a touch lighter than 45,000, so no real shock there. ISM non-manufacturing, a little bit better than expected today, 54.4. Consensus was 52.2. Services sector accelerated in December to its best level since the beginning of 2025. And it really is the most expansionary reading since May of 2025. November JOLTS, that's the job opening data. Recall, 2 years ago, year and a half ago, when everyone was worried about inflation. That jobs openings number, these are available jobs, was close to 10 million. It's now at 7.1, while still good. It's a big number. It's less good, and it's revised. The prior was revised lower to 7.4 million from 7.6. So it's showing that available job openings are decreasing, and this is, again, we'll touch on a little bit later in the show, one of the concerns around the growth of AI. And I'm of the opinion that we're not at the firing phase of AI. Maybe high tech is, but we're at the I'm going to wait to hire phase. And it will lead eventually to the cut staff phase. But near term, companies don't know yet what and how efficient they can be with some of these new tools. And some will spend a ton of time and really gain nothing from it, while others will find a ton of synergy inside of their company that may replace some inefficiencies and most likely replace people on staff. So keeping an eye on those JOLTS numbers. They are coming down, which I would say is a deflationary or disinflationary number that we received today. Looking over at some of the news items, as I mentioned, Trump said interim authorities in Venezuela will be turning over between 30 and 50 million barrels of high-quality sanctioned oil. It's actually not super high quality. It's tougher to refine. But you saw some of the refiners, Valero, et cetera, do quite well because of the East Coast exposure, which is most likely where a lot of that is coming in. And the oil will be sold at its market price. I mentioned earlier in the show that a lot of the funds that are coming from these sales will be kept in U.S. banks and redistributed back to Venezuela once they get their act together, for lack of a better term. Secretary of State Rubio tells lawmakers that Trump's goal is to buy Greenland and downplays military action. Senate Majority Leader John Thune also said U.S. military takeover of Greenland is not something that anybody is contemplating seriously, according to The Hill. Trump's going to be meeting with oil executives Friday to discuss plans to fully enter Venezuela and help rebuild that country's oil exposure. And right now, I think that it's just one of those times that we're going to have to wait and see. But for now, I think at least near term, a lot of the commentary around the country and the state of things leave a lot to be desired. So if all things are said, we get a positive outcome at some point in the future from all these changes. Bank of America has elected to change their accounting methods related to tax-related affordable housing, eligible wind renewable energy, and solar renewable energy equity investments. They had some write-downs inside of there that they were looking to change. And in fact, today, Donald Trump made a comment, which we will hear more of, that as much as said that he's going to forbid many of these REITs and things that have been buying single-family and multifamily homes, mostly single-family mentioned, because they're not living in these homes. And that the concern is that it's driving up housing prices because they're just sitting inside of investment portfolios instead of truly being able to let home buyers own them in lieu of big corporations. So we're going to hear more about that certainly for sure. Google, interesting comment by the Wall Street Journal today saying that when Google fell behind in the artificial intelligence race, it created a powerful new model. And that's what you've seen with the latest iteration of Gemini, where people thought Google was way behind the curve. And ironically, like I've said before, you want to chase those that have the data, right? Apple's one of those companies that has all the data, even though they may not have the leading edge on large language models. They have the data, and down the road, the data is going to be the most important, and Google is very much the same. They've got the data, both user data as well as all the advertising and true informational data that's going to be required to put them ahead of the rest, and I think that's really what the Wall Street Journal is touching on. JP Morgan is going to be taking over Apple's credit card from Goldman Sachs in a $20 billion deal that was just recently announced. Meta stock was down today. Supposedly they're going to be delaying the rollout of the Ray-Ban display glasses, according to Reuters. They keep getting a lot of these start, stops. And it's been pretty interesting that company, they get the benefit of the doubt. But if they don't take advantage of what many are viewing as the next leg in AI digestion, these glasses, I mean, if you've ever tried the bigger glasses that go over your full face, they make you seasick. But the glasses that Ray-Ban have been mentioned to and offered and showed and demoed seem like a pretty interesting product. Not that I'm going to get one, but I think that is something that could have true adoption into the future. Microsoft OpenAI aims to turn ChatGPT into a personal health hub using wearable data, according to the information. So that, again, leads very much into the meta comments. And Samsung, you've seen strength in SanDisk. Western Digital has earnings out tomorrow. A lot of these memory chip, Micron has had good numbers. Samsung executives expect memory chip supply shortages to increase in the future and also increase prices of electronics, right? So that part is going to be notable, given all the costs that are going into many of these things, and now all the memory that's needed for AI and both on the agentic side or just general AI. And it's going to cause prices for lots of things to go up on the technology side, just truly because of the demand equation that we're continuing to grow and grow and grow. So after the break, I have a article from the MIT Sloan Management Review, and these guys are great. Thomas Davenport, Randy Bean. They have a emerging 2026 AI trends list that they think leaders should understand and be prepared to act on, and I'm going to fill you in on that after the break. But why don't we first check in with my good friend Jack Saban, who has news, traffic, and weather. How are you, Jack? Welcome back to the Jon Sanchez Show here on News Talk 780 KOH. This is Jason Gaunt. Today the Dow finished lower by 466 points, 0.94%. The S&P was down 24 points, 0.34%. And the tech-heavy NASDAQ was higher by 37 points, or 0.16%. Gold higher in the new session by $9, and oil is higher by 0.7% to $56.38. So I mentioned AI. I know we've heard lots about it. Everyone's heard lots about it. But I found a cool article from the MIT Sloan Management Review that I was reading earlier today, and I thought it'd be good to read to you. Really, some of the things that change, these guys are forecasters. They look and say what they expect to happen over the next couple of years. And the topic is, here are the emerging 2026 AI trends that leaders should understand and be prepared to act on. Organizations tend to change much more slowly than AI technology does this day. This means that forecasting enterprise adoption of artificial intelligence is a bit easier than predicting technology change in this, our third year of making AI predictions. Neither of us is a computer or cognitive scientist, so we generally stay away from prognostication about AI technology or the specific ways it will rot our brains, though we do expect that to be an ongoing phenomenon. However, AI seems to have moved beyond being just a technology to becoming a primary force driving economic and stock market growth. We are neither economists nor investment analysts, but that won't stop us from making our very first prediction. Number one, the AI bubble will deflate and the economy will suffer. Last year, the elephant in the AI room was the rise of agentic AI, and it's still clomping around. We'll touch on that later. This year, it's the AI bubble that has monopolized discussion. Is there one? If so, when will it burst? When will money rush out quickly? Will it rush out slowly? What are the implications of the broader economy and the ongoing use of AI? Both of us have been around for a while and remember that deflation of the dot-com bubble. It's hard not to see similarities to today's situation, including the sky-high valuation of startups, the emphasis on user growth, remember eyeballs, over profits, the media hype, the extensive infrastructure build-out, etc., etc. The AI industry and the world at large will probably benefit from a small, slow leak in the bubble. Will this bubble burst? It seems inevitable to us that it will, and potentially soon. It won't take much for it to happen. A bad quarter from an important vendor, recall DeepSeek, the crash in January 2025, or a few AI spending pullbacks by large corporate customers. We hope the deflation will be gradual, which might mean the overall stock market would have time to adjust, and for investors to move some of their highly inflated AI vendors out of their portfolios. A gradual decline would also give us a breather with more time for companies to absorb the technologies they already have, and for AI users to seek solutions that don't require more gigawatts than all the lights in Manhattan. Number two, more all-in adopters will create AI factories and infrastructure. Companies that are all in on AI as an ongoing competitive advantage are putting infrastructure in place to speed up the pace of AI models and use case development. We're not talking about building big data centers with tens of thousands of GPUs. That's generally done by the vendors. But companies that use rather than sell the AI are creating AI factories, combinations of technology platforms, methods, data, and previously developed algos that make it fast and easy to build AI systems. This is the phase that I think we're in right now. Leading banks adopted this approach several years ago. They had a lot of data and a lot of potential applications in areas like credit decisioning and fraud prevention. For example, BBVA opened an AI factory in 2019. JP Morgan Chase created its factory called Omni AI in 2020. All that time, the focus was only on analytical AI. We described AI factories in consumer products now. Procter & Gamble, Intuit, etc. This generative AI operations systems are building and growing. Companies that don't have this kind of internal infrastructure force their data scientists and AI-focused business people to each replicate the hard work of finding out what tools to use, what data is available, and what methods and algorithms to employ. Not being able to build a foundation makes it both more expensive and more time-consuming to build AI at scale. Number three, generative AI will become more of an organizational resource. If 2025 was the year of realizing that generative AI has a value realization problem, 2026 will be the year of doing something about it, which we must confess we predicted with regard to controlled experiments last year. They didn't really much happen. One specific approach to addressing this value is to shift from implementing generative AI to individual approaches or enterprise-level approaches. For example, when general AI became broadly available, it was so easy to use by almost every business person that many companies made it available to anyone who was interested. In many cases, the primary tool set was Microsoft's Copilot, which we internally use a lot. It's dynamite, gives you wonderful view through all of your data, etc., but it's general. It's nothing crazy. It's really good at generating emails. I don't do it that way, but you can. Written documents, PowerPoint, spreadsheets, etc. Really, these types of uses have generally resulted in incremental, and I like this, and mostly unmeasurable productivity gains. And what are employees doing with the minutes or hours they save by using general AI to do such tasks? Nobody seems to know. Most users of Gen AI have been generally incremental and mostly immeasurable. Aids to productivity overall. The alternative is to think that generative AI primarily as an enterprise resource for more strategic use cases, like R&D, supply chain management, sales functions. That's what I talked about earlier with biotech, right? Like where people now have these tools that they can make things happen faster. Instead of testing in days and weeks, you can test in seconds with prior tests. This is what happens when this happens. You can spin them through a machine and really do a lot of testing a heck of a lot faster and then iterate on it. The software, the system can go look at the gene editing, et cetera, and make a lot of inference from it that it would take a human a heck of a long time to do. Number 4, agentic AI will still be overhyped, but will likely be valuable within 5 years. Last year, like virtually everyone else, we predicted that agentic AI would be on the rise. Although we acknowledged that the technology was being hyped and some challenges, we underestimated the degree of both. Agents turned out to be the most overhyped trend, well, generative AI. Generative AI now resides in the delusionment phase. So what are the problem with agents and what are agents? They're generally aren't ready for prime time business. Various experiments by vendors and university researchers, including Anthropic and Carnegie Mellon, have found that AI agents make too many mistakes for business to rely on them for any process involving big money. Then there are the cybersecurity issues of agents in particular, and their tendency to become deceptive and misaligned with human values and objectives. Right? So agents are something you'd wrap around the data that you can train it to go do things for you, like open up a new account or those simple things. Not that agents are simple, but that is a simple example of what an agent can do for you versus, hey, go write me an email that could be some generative AI. In this case, it's a process doer, right? Go do this for me or provide this task for me. And that's what they still are claiming are far away from prime time because they have too many inherent errors. Next, the debate will continue over who should manage the AI. And I think that's the biggest thing is where does it fall in a company? Data and AI Leadership Exchange uncovered some good news for data and AI management. Virtually all of the respondents were positive about AI's role, saw data and AI investments as a top priority, and plan to spend more on them. Almost all agreed that AI has led to a greater focus on data. Perhaps most impressive is more than 20% increase over last year's survey results. The only challenging structural issue is the picture as to who will be managing this and to whom they should report inside the organization, given that it's sort of everywhere, right? Not surprisingly, a growing percentage of companies have named chief AI officers or an equivalent title. This year, that title is up 39%. The problem is there's little consensus about to whom the job reports. Only 30% report to a chief data officer. Other organizations have AI reporting to leadership, technology leadership, or some transformation leadership of some kind. We think it's likely that the diverse reporting relationships are contributing to the widespread problem of AI, particularly generative, not delivering enough value. Essentially, progress is being made in the value realization, but it's probably not enough to justify the high expectations of the technology and the high valuation for their vendors. Perhaps if the AI bubble does deflate a bit, there'll be less interest from multiple different leaders of companies in owning the technology versus using it from others. So really what they're saying is we're at a crossroads here. I think we've done the easy stuff. We've done the big money's been made on the NVIDIAs, in my opinion, the makers of the tools that now companies in the Procter & Gamble and Cat Tractor and Goldman Sachs and you name it are going to now be in the efficiency phase. And that is where you want to watch the JOLTS data and see down the road, are job openings getting smaller or are they changing, right? Like everything. It's always this fear of, all these jobs are going to go away. That's always been the case. But guess what? Phoenix rises from the ashes. There will be new things. There will be new roles. There will be new jobs, even if it's, chief robot cleaner or whatever the heck we get in the future from Tesla automation and such. But I wouldn't fear the fact that AI is going to take away everybody's jobs and we're going to have universal basic income. But I certainly think that AI and the use cases are going to expand greatly in some areas and probably be honed and pulled back in others. But that's what makes a market. And I still think we're a ways away before the bubble stuff really becomes an issue. But why don't we then wrap it up with Kristen Snow in the Right Now Traffic Center. Welcome back to the Jon Sanchez Show here on News Talk 780 KOH. This is Jason Gaunt. Taking a look at the pre-market futures, not a ton going on here. We've got the Dow futures higher by 14 points, the S&P futures higher by 3 points, and the NASDAQ futures, they're down 6, so not much going on. Oil is trading at $56.35. That is about 36 cents higher on the day. 10-year at $4.15. That is 1 basis point higher. But as I mentioned earlier in the show, bonds have been pretty darn mellow. Really, farther out is where bonds are interesting, right? The short end of the curve is right around 3.5, 3.6%. So all of you who have high yield savings accounts, you're probably seeing, low 3% type rates there, just because banks like to make a little bit of money. 2-year bond is trading at 3.48. Remember, that is what lots of folks will look to say, what's the implied level of Fed funds 1 year from now. So that gives us close to 50 basis points of cuts into 2026. 10-year again at 4.15, but the 30-year is at 4.83. So what that's telling you is the market says, sure, near-term rates are low, but inflation and the cost of U.S. borrowing will most likely cause longer-term rates to be higher than where they are now, regardless of who's telling the Fed to do what. So a little bit of information. Let's look at the bond curve to tell you where things are going in the future. Speaking of the future, tomorrow, a fair amount of economic data. We're going to get preliminary Q3 productivity numbers. We're going to get unit labor costs as well. An October trade balance. Consensus is looking for $61 billion in the negative column, unfortunately. Someday, hopefully, we can get that on the right side of the ledger. Weekly jobless claims. Looking for 217,000. The prior was 199. That number's been in the high 100,000, low 200s for some time now. I think any big move outside of that range could cause either angst. Higher job losses clearly would be signaling of a concern in the economy, or too many jobs being added. We get sort of a fear around inflation picking up again, especially in the face of a very strong ISM manufacturing number today. Continuing claims, right at 1.86 million, right around 1.9 has been the average levels. So nothing crazy there in terms of continuing claims, just stating that while there are new jobless claims, people are finding jobs down the road. It's when that continuing claim number gets back above 2 million plus when I think angst will again start to kick in. If so, October wholesale inventory is about midday. Natural gas, very volatile. Nat gas, I think, was mid to high 3%. Scott is up in the fours a couple weeks ago, but has come down. Looking for a draw of 38 BCF. And then consumer credit for November, not a big number, 10.3 billion, but a touch higher than the month prior. Earnings were in the quiet period. As I mentioned, banks weak today. JP Morgan was down 2.5%, I think. They've been strong over the last month or so. Banks are going to start earnings. That's going to be the first thing that the market will watch for. What are banks saying? I saw someone today saying that they thought that this was going to be an epic earnings quarter, as in epic good, I guess. But mentioned low double-digit earnings growth is what is expected for 2026, which is favorable for investors. There's not some big panic of a deceleration of spending or a deceleration of companies' growth over the next 12 months, which is a positive. Again, a reason for not trying to get freaked out with every headline or news flow, right, that we're seeing. And, we're seeing quite a few of them at this point. Pre-market earnings, we're going to see CMC, Helen of Troy, RPM, SNX. And then after the hours, I mentioned Western Digital. That's going to be one to watch. And GBX, the train maker. I do appreciate it. We're going to be back tomorrow. I'll have the real estate fellas with me. And, it's always a fun time. John, as I mentioned, will be out the rest of this week. And I get to be your humble host. Looking forward to it. Always enjoy doing the show. Thanks a lot for listening. We'll be back with you tomorrow on the Jon Sanchez Show, News Talk 780, KOH.
Jon Sanchez is a registered investment advisor, and the opinions expressed by Sanchez Gaunt Capital Management, LLC on this show are their own and do not reflect the opinions of News Talk 780 or its parent company, Cumulus Media. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.